Very good evening to you all, ladies and gentlemen. My name is Shadhir Jannath, and I am the media coordinator for Stock Exchange Mentoring Private Limited. So we as a company, since the day we started, we have been teaching courses relating to capital market investment schemes. And as you all may be aware, for the past couple of months, we've been doing our part teaching the basics of fundamentals in capital market and all that for the past 6 months. So now we are taking the next step and planning an advanced technical course. And today, this will be your chance to get a glimpse of what we have in store for you guys. So, without further delay, I would like to call upon today's lecturer, Mr. Shadhir Jannath of Candor Equities Limited, for his presentation.
Okay, thank you, Shavindra. As Shavindra mentioned, stock exchange mentoring, in addition to the fundamental analysis, this is an introduction of technical analysis, where I hope most of you are familiar with fundamental analysis and other analysis methods, which will be useful to make your investment decisions. And also during these market days with so many bullish momentums and also recent bearish market sentiments, there is another element, another aspect of analytical method which people require, which is technical analysis. So today in our session, during our 1 hour webinar, we will give an introduction to technical analysis, how this will be useful for you to make your trading decision, where does it fit into your overall investment decision making process, and we will show you how what are the benefits you can get from this and how this can be integrated with your overall analytical method and trading strategy to become a professional trader. So that is the objective. So without taking any further time, I will share the presentation now. Okay, I hope everyone can see the presentation slides. So when I spoke about becoming a professional trader, one of the important aspects is there are 3 main elements you need to sharpen and you need to mainly focus to become a successful trader. Going through many professional traders and of course trading gurus like Warren Buffett to Paul Tudor Jones and George Soros, all those kind of traders, something these are the common things through their talk shows, through their authored books, what we witnessed. These are the main 3 elements which mostly identified and mostly spoken. So if we can target these, and also where does it fall, where technical analysis falls into this overall aspect, if we can understand that, that will be very good. Okay, so I will start with the number 1 thing is psychology and discipline. So when it comes to most of the traders, this is an area which they don't have. Then the psychology and discipline aspect is something very important, which helps you to keep in balance. Some traders they have very good analytical skills, trading strategy, etc. But when it comes to the emotional balance, they fail to make that balance when they encounter the real market conditions. So that balance in their emotions, where they control their fear and greed element and execute the market trade plan, their trade strategy, without any emotional imbalance. And to do that, you should have a strict discipline to execute your trade plan without any issues. Okay. So then the next element is trading strategy. So trading strategy is where our technical analysis, fundamental analysis, all these analytical methods, and also a complete trade plan falls into this. So in this aspect, we will learn about all the analytical skills. I think some of you all already have understood what is the importance of fundamental analysis and how to use this to improve your trading decisions. And within this trading strategy category, also technical analysis will fall in, where you will use that method also to integrate and to make an overall decision making. And then comes another very important area is the money management. A lot of people, they have everything. You can see the balance of psychology and the excellent trading strategy. But when it comes to money management, their risk management strategies, how much they have to, allocate, and what are the risk levels, the stop loss levels they should consider to exit trades, and what you call and take profits, book their profits. All those things are very important. So though they have an excellent trading strategy, if they don't have the proper money management and the risk management skills, all these aspects will be failed again. So you can see this this, I call it a trigon of a successful trader. So all these three aspects should be properly balanced, and you have to continuously grow through all these areas to become a successful trader. So out of all three these concepts, technical analysis falls into this trading strategy area, which is an area to improve your overall trading strategy. So today we will be going through that and give you an introduction on what is technical analysis and how it is useful for you to make your trading decisions. So first we'll talk about what is the purpose of technical analysis. Okay, so it's better to understand the purpose of this, then you will know whether this will be useful for you as a trader or not. If this doesn't suit you, if this doesn't help you at all, then there is no point in taking the trouble to learn this subject or maybe use this in your investment decision making. So to fit this into the overall investment decision making process, I would suggest an approach. So the suggested approach for stock selection and investment to timing, to time as an active investor. First, out of if let's say in the Colombo Stock Exchange there are about more than 280 plus stocks. So out of all these stocks, you should have the first level of filtering is to identify the fundamentally strong stocks. Okay, so once you filter the market to identify the most fundamentally strong stocks, that is your first level of filtering. So that saves you with a lot of trouble, where you will not be focusing, wasting your time with those stocks which are not fundamentally strong. So once you have done that fundamental analysis and you have understood the stocks, the list of stocks which have that fundamental strength, so you can filter those stocks to focus your universe. So that will be your universe to focus. So then out of all those 280 plus stocks, let's say you find out fundamentally strong stocks about, let's say 50 stocks. Then out of those 50 stocks, maybe all those stocks are not liquid enough to trade. The liquidity is how fast you can buy and sell those stocks. Because when it comes to technical analysis, you need to be an active trader. Mostly you should be an active trader. So to become an active trader and using technical analysis in line with that, it's those stocks should be, to execute your trading decisions, the stock should be liquid enough to trade. So to identify that liquidity, there are multiple methods through a ranking of liquidity out of all those stocks, the volume movement of that stocks compared to other stocks, and how the trading intensity and the pricing intensity, which is another subject matter. But for the moment, you should understand the process is, once you filter the market with the fundamentally strong stocks, then the next level of filtering is liquidity of the stocks. So let's say out of those 50 stocks, you found out about the most liquid stocks, about 30 or 35 stocks. Then you apply for those 35 stocks your technical analysis strategy. So your technical analysis, we will be talking about chart analysis, indicators, and with these indicators and tools, you have a combined integrated confluence setup, which we will discuss in a minute. So that is where for those stocks you will apply technical analysis. And then once you have a technical analytical method, your final step, which is also very important, you should have a clear trade plan and risk management guidelines, risk management rules before you enter the market. Because when you enter the market with these rules and a trade plan and risk management what do you call appetite guideline, with that, if you approach the market, you will have a controlled investment decision making throughout this chaotic market environment. Otherwise, what will happen if you approach the market without a proper plan? You just get excited and you become a trader with impulse trading decisions. So to avoid that, you should have this trade plan and a proper risk management rule guideline. So this is, you can see, as a professional trader, if you have this workflow, any retail trader, any individual trader, you should treat this as your own business and take it seriously, and you should have this kind of a filtering method. This is how, and of course during these market conditions you would have witnessed during the bullish cycle, there are multiple stocks had a bullish run, but some stocks didn't have. But at the same time, some stocks started to fall down drastically. So you would have seen multiple stocks acting in various different ways. But if among all these chaotic environment, if you have this kind of a structured process, structured workflow and approach, this will make your life easy and make you more professional to approach the market. So this is very important. So I would suggest some people, what they try to do, they simply apply, get excited with this technical analysis, and they start with technical analysis and go the other way. Maybe after that, they don't know even what they're investing, whether that stock is fundamentally strong or not, whether that stock is liquid enough or not, but they simply apply technical analysis and they start trading. But at the end of the day, when the market starts to show them that the stock is not fundamentally strong and not liquid enough, they are unable to execute their technical trading signals, etc., and then they fall into trouble. So this approach will make you a professional investor and to facilitate you to approach the market in a very disciplined way. Okay, so this is the suggested approach. So then we'll take an example, why technical analysis, how it will be useful for you to make your trading decisions. For example, if you see this particular chart, this is dialogue. I have shared this chart from 2017 to 2020 until June period. You can see the stock from 2017 at 10 rupee levels. From January 2017, the stock goes from 10 rupee, reach to a peak level of 1450 levels. Then again, it drops down drastically to 8 rupee levels. Then again, goes to a peak of 14. Then you can see June again, it's trading back at 10 rupee. And currently, I think it's trading somewhere 12 rupee and 13 rupee range levels. So what you have to understand is there are trading strategies you can have. So let's say if you are a trader who used to trade like in a fashion, you buy and hold it for a long term, kind of a lazy portfolio, you will be holding this stock from January 2017, and the stock has gone up to 14, then it has dropped down to 8 rupee, again gone up to 13. But again, you see after about almost 3 years, you are at the same level, right? With the except for the dividend returns, the capital gain is nothing much. So you can see this gives you a huge opportunity cost, and with the time value of money, you are losing, in fact. So to avoid this, some stocks you can't do this kind of a buy and hold strategy. So out of let's say in the Colombo Stock Exchange, there are plenty of stocks where you can trade this cycle similar to like Dialog. You can take that capital gain and make multiple trade instead of buying and holding it for a longer period and making no return. Instead of that, there are plenty of stocks where you can actively trade and make money. So you can see buy and hold for long term or time the market. Now the question comes whether to buy and hold, or do you want to time the market and actively trade and maximize your capital gains and maximize your returns. So this is why technical analysis will be very handy and will be very useful for you to make your trading decisions. So let's see how the next chart. The next chart shows the same stock, the multiple trading opportunities you can have. Let's say now you, instead of buying and holding it till for a longer period without trading, you buy and just keep the stock, and then the stock moves in value up and down. But after that, uh, goes to the same value. Instead of that, what you can do is now you trade at 10 rupees, then you sell at 12 rupees from Jan to July. Then again you find the stock is slowing some momentum. Again you see the trend, there is some trend developing. So then you start buying the stock at 12.20 and again sell at 14.30 levels. Then after that, there's a huge bearish trend the stock is having. So those during those period, you can completely avoid the market and maybe do your homework on fundamental analysis and be prepared for the next cycles. Since our markets are only long opportunities, there are not short trading facilities. But currently, based on our long trading, where you buy low and sell high. So then you again buy at 9 rupees, again sell at 10, and maybe then after that you find out there's still momentum continuing, then you buy at 11, and maybe not at 12 rupee, 14, again you sell at 12.60. Then avoid the, during the pandemic, maybe because of the market panic, you have exited before that. After that, again you find out the stock has discounted at low levels at 8.50 and then sell at 10.50. You can see now the same stock gives you the opportunity to make multiple trades and to maximize your profit opportunities. Okay, so it seems very easy when looking at this chart. Okay, come on, I have to just buy at these points and sell at these points. It looks very easy. So if I can do this, then that's all right. But it's easier said than done. The challenge is how to find these points where you enter and then where you exit. Okay, this is the challenge. This is the challenge we have. So where to enter and where to time the market to enter, timing to the point where you have to buy and the point where you have to sell. To get this timing, you can take a lot of benefits and take signals from technical analysis tools. In addition to the fundamental analysis target price levels, it will give you the opportunity to identify these timing opportunities. Okay, so we'll see how this can be useful integrating our technical analysis tools. So now, by now, you should understand what we are trying to do is, instead of buying and holding for a long term with a fundamental target price, which is totally fine, but in fact, in between, if there are multiple cycles you can trade and maximize your profits, then only thing you have to give some extra attention to the market and some extra time. And based on that, with these tools you are going to use, you will have multiple trading signals which will help you to time the market and entry exit points. Okay. So the market will have mostly these kind of cycles where we will find out a reversal where the trend comes down, and there's a reversal where the momentum slows, and then the new trend direction, bullish trend will start, an upward trend, which is also a bullish trend, also known as a bullish trend. Then again, the market, the bullish trend can slow down, and that momentum slows, and there is a reversal happens. Then after that, after that reversal, maybe the market goes to a new downtrend. So these upward and downward reversals and flat long accumulation and distribution points will occur many times in the market. So if we can understand these cycles and to analyze these price actions, this will be very helpful for us to make our trading decisions. Okay, so based on this, if we explore the stock, which we were already discussing, dialogue, you can see the same kind of a reversal where the stock was having a downtrend during this period, and then after the downtrend, the stock momentum slows, then there is a reversal, and then there's a new uptrend begins, then that uptrend starts to slow down, then there's a new downtrend starts. So within these uptrend and downtrend points, you can clearly see the fundamental value, let's assume that you have a idea of 12 rupee, the fundamental value of the stock. Sometimes the market sentiment, due to rational or irrational reasons, you know, sometimes even after the fundamental value, the stock can go further up. So to take these opportunities, technical analysis will help you to see whether the market direction is going still in that same direction, and take that extra mile, and maybe you know, secure more profits. And also, let's say if the market is going down, even if you know this is the fundamental value, you might think, okay, I'll buy here. But what if the market is still going down? Though the fundamental value is there, if the market is going down, you can't argue with the market. So what you have to do is, what is the turning point which will help you to time the market? Instead of wasting your time here trying to average the downtrend market, you time the market. Once you understand, okay, you back in your mind, you know, it's fundamentally the stock is valued at 12 rupees, but what is the right timing where you don't have to waste your money with an opportunity cost where your money is stuck in a downtrend? Instead of that, you identify these clear reversal points, and then you time the market to enter at these levels. And then even after it goes above the fundamental value, because of irrational market movements, you take that extra mile and have maybe super profits above that fundamental value and make money. So you see, these opportunities, how to identify these points, in addition to the fundamental analysis, with the fundamental analysis idea back in your mind, you can take that extra benefit to time the market and exit at better positions, which is how technical analysis will be useful. So with that in mind, with that introduction, we will now just go through the basics of technical analysis. So to give you an idea on the basic definition of technical analysis is a trading tool employed to evaluate securities and attempt to forecast their future movement by analyzing statistics gathered from trading activity, such as price movement and volume. So now you can see the main thing is price movement and volume and trading activity. So instead of fundamental analysis where we go through the company's financial statements and their business aspects and management decision making and the economic, macro and micro conditions, we will be mostly focusing on price movement and volume, and to understand based on that price movement and volume, to understand the mass market idea. So based on the price and volume movement, we try to gauge the idea, where is the market heading? What is the current mass market sentiment? Whether the market is bullish, is it into a upward movement, or they are in a panic moment? You can see, though whatever the style the economy was, with excited global reports during end of 2019, with optimistic reports. However, after the pandemic, we saw the market started to crash at the initial stage. So during that time, the market price movement information was the key idea, where it gave us a lot of information where the market is heading. So based on price movement and volume information, we will be exploring a lot of charts. So when it comes to technical analysis, mostly we will be working and dealing with charts. That is the key aspect. That is why price movement and volume will be a primal important thing which we will be using for our analytical methods. Okay, so keeping that definition, starting with that definition, we will just break the subject and see how these tools will be useful for us to make our trading decisions. The requirement is to identify trends in action and the trend reversals. Can you remember the previous charts we spoke about? If you can identify those reversal points and the trend continuations, this is all we need, right? But to identify those points, we use technical analysis, where we will analyze price, action and volume analysis, which is will broadly categorize into chart analysis. Then we will be using indicators of those for those price and volume data. We will be using secondary indicators to get a more average perspective idea, comparative perspective idea, which will give us a more idea on how the market is performing based on historical levels. So these indicators and this price volume data will help us to identify these reversals and trends to make our trading decisions. So the pattern of prices and volume reflects mass psychology of the market, rational and irrational movements. Sometimes the market, even if you have the best idea the market should go this much, or it should, let's say a particular stock, you have a feeling and you have read all the reports and everything, it's from 50 rupees, it should go to 100 rupees. And if it doesn't go from 50, it starts to go falling down from 50 to 40 to 30. That is the mass market behavior. So if you don't understand that and take your investment decisions based on those mass market movements, maybe it could be an irrational movement. Yes, it is fundamentally justified, the price should go up, but sometimes this can, because of an irrational reason, the market can go against you. So this is why you need these technical tools to save yourself, maybe with a proper risk management strategy, or maybe sometimes market, though the stock even after the fundamental reaching the fundamental value, the stock can go excessively because of because of market bullishness or too much optimism for the stocks among the buyers. So you can take that advantage through technical analysis, those rational and irrational movements. So now you can see the main aspects is if we can broadly divide the price action, volume analysis and indicators. So first we'll speak about chart analysis, which we will be talking about mostly price action analysis and volume. So during our this introduction webinar, I will take you through some key aspects of within this timeline on these two main categories, chart analysis and indicators. So first I would like to touch one of the most important areas when it comes to chart analysis is supports and resistance. Support and resistance levels are psychologically important levels where a lot of buyers and sellers are willing to trade the stock. When the trend lines are broken, the market psychology shifts into new levels of support. So the main thing we have to understand is, I have taken this example, Microsoft. You can see there is some resistance for this particular stock. Whenever it reaches 55 levels, again it goes, and there is support for this stock at the price level of 45. Then again it goes to 55 levels again, there is some resistance. So can you see the previous 55 resistance, whenever it touches that same level, the stock reacts and further goes down to the same previous level of 45. But when it touches 55, can you see the volume bars, the below the volume bars also increasing? That shows whenever the price reaches these 45 levels, there is market interest. The buyers find out, they feel some emotional element to this price level, maybe a rational reason, or maybe a justified fundamental reason, or maybe an irrational reason. But based on our chart analysis, this gives us a very good information. There is 45 is a very important level for the stock. Whenever it reaches these levels, there is some support, and whenever it reaches these levels, there is some resistance. But understand, there are these resistance and support levels doesn't always stay. Sometimes multiple times it might have those resistance and support strongly, but after that, when the market is advancing with new information or new news or new excitements, the market can break those levels and move into new levels. So when it goes to a new level, this former resistance converts into a new support. So this is how these supports and resistance will be useful for us to make our trading decisions. So we will quickly go through some examples of the Colombo Stock Exchange recent charts, how these supports and resistance levels are useful. So for example, Tokyo, during October, November, December, clearly you can see every time it reached 68 levels, thrice the resistance was there. The stock, there was clear resistance after it reached 68. The second time it reached 68. And then if you identify these resistance points based on two points, these levels, definitely this future point will be a useful information for you to make your trading decisions. It might break, but it might sometimes again reverse. The price can be rejected at these levels. But what you have to understand, this price information, this chart, based on this candlestick chart, it gives us valuable information for this particular stock. 68 rupee was having some psychological element. Whenever the price reached that level, it had some price reaction, it had some price rejection, or it could be a breakout. But what happened after that? In fact, Tokyo broke this resistance level and went up. But however, this gave us some information. So this might be this line, if you extend in your chart, will be very useful for your future reference. Again, Haley's MGT. This is before the subdivision of the stock. You can see how a trend support line I have taken. So if you have identified these points and extend this trend support, every time the stock touched the trend support levels, it maintained some support and it moved in this direction and this. So you can see this is an upward trend support. So this price action analysis will give us the idea. If you can identify these trend support patterns in this chart analysis, this will give you some valuable information for your future reference. Maybe in future these levels can have supports again, or maybe then break below this. So if these trend supports are breached, then we can assume this trend is no longer continued. Maybe the stock will continue to downward, or maybe into a range, kind of a flat direction after breaking out, or maybe it can further go down. So these kind of market directions can happen. But until that is executed, until it remains above this trend support, this is a confirmation for us. The stock is maintaining this trend support and it's heading toward the upward direction. So if you are following this trend support, whenever the stock reach these trend support levels, it is a trading opportunity for you. If you are closely monitoring the stock to actively trade, this could be opportunity for you to add more to your position, or maybe buy and exit multiple times this particular stock. Okay, so you can see how the trend support price action analysis is important to make your trading decisions. Again, CIC Holdings, I would like to show you with volumes how you can see every time the trend starts to touch, we can see the volumes are going above rev. The below chart shows the volume bars. So the volume movement, every time the trend support is, the stock reaches the trend support, that shows at that time buyers having some interest identifying the value of that stock, and they find it, the stock is coming to a correction within the uptrend, and there are more buyers coming, and we can see volume movement in that. So you can see every time it reaches these support levels, trend support levels, the volumes are increasing, the volume bars compared to the average level of the volumes, you can see the bars are increasing. So again, the same way, it went up through a nice trend support, then after that, from that trend support, the stock had a big momentum, then it reached its resistance levels, and again the second time it touched the resistance levels, and you can see the second time when it touched the resistance levels, there is some selling pressure at that level. So maybe at that peak level, the sellers, the sellers would have thought, okay, this is and the buyers are not having much interest, and there's some selling pressure from that point, and then from after that the price started to go down and the price is rejected from 75 levels, and maybe it can have some support at these levels and again move up back and test that resistance levels previously. So you can see these key levels, if you have identified and kept in your chart, these will be very valuable information for you to make your future trading decisions. So these volume analysis and trend support patterns and these resistance lines and the volume analysis together, this gives you a lot of information how this particular stock at these price levels are reacting. Okay, so if you the normal tendency is beginner traders, technical analysts, they like to apply the indicators because the indicators are very flashy, bling bling, and with all those fancy names, Fibonacci, Bollinger, you like to apply those, and you think sometimes you find it's so nice, it is giving you buy sell opportunities and signals, simple as that. But we will see how these technical indicators can give you some premature wrong signals and sometimes put you in trouble. So that is why, when you become a professional trader, once you understand from beginner level, once you advance, you will give more time to naked chart analysis without putting technical indicators. If you can simply analyze these naked charts with simple price volume data, these trend support lines, top resistance lines, all these things are very important information more than the indicators. So give more priority to chart analysis, and for those chart analysis you can apply technical indicators and get a better idea. So don't go the other way. Some people, just simply apply the indicators and completely ignore naked chart analysis, because price action analysis will give you a lot of information and a good idea about where is the market is heading, what is the current trend, and how is the price reacting at these support resistance levels. So it is very important. Don't neglect this chart. I know chart analysis might be very boring. You have to analyze these naked charts, but believe me, chart analysis, in addition to, before going for technical indicators, if you can improve your skills, analyzing this naked chart to identify these kind of trend, support and resistance levels, that will really add value to you to make your trading decisions. Okay, so keeping that in mind, we'll go to the next section, technical indicators. So technical indicators are really, during these days, among amateur traders and beginner level analysts, they are excited to use these indicators. You might be seeing so much circulating through social media, etc. These Fibonacci levels, Bollinger Bands, MACD, Stochastic, all these indicators. So sometimes the problem is you can't only make your trading decisions based on one indicator, and sometimes some people find out maybe one indicator working for them as a holy grail, and they get excited and they stick to that indicator. But the market might teach you a lesson with a thundering slap, maybe, where it shows that indicator is not all what it is, because sometimes all those indicators are not 100%, you can't guarantee. That is why we have to have a confluence setup, which we will talk about at the latter part of the session. But for the moment, keeping that in mind, I will just quickly explain you what are technical indicators. So technical indicators will help you to identify. So keep this in mind. These indicators will help you to identify trend directions and reversals. So can you remember, if you recall the initial slides, those price patterns, the price going down and then it starts to go up, and then at the peak level it hits the resistance and turns back. Okay, so to identify these trend direction and reversal points, indicators will facilitate based on their functions. Okay, so keeping that in mind, how these indicators will help, what are the features it has to identify trend direction and reversals. There are two main categories of indicators. One is trend continuation indicators and oscillators. So trend continuation indicators will give us the direction where the market is currently heading, whether that trend is, let's say the market started a trend, an upward trend, you want to know, like for example, these days some people were saying, okay, Expo Lanka started from a rally from 5 rupee, 3 rupee levels, it went up to 40 and 60. Everybody was asking the question, whether it will go further or not. So this is where your trend continuation indicators will help us to give you an idea. Despite the market volatility, based on the indicator, it will confirm you, hang on, though there are volatilities in between, currently the indicator is pointing upward. So there is nothing to worry, you can continue your trade. So this kind of signaling will be facilitated through our trend continuation indicators. However, this trend continuation indicators, since this works based on statistical models on historical price volume data, this to process that direction, to confirm that direction, these can be lagging indicators. Even after the trend has started, the indicator will give you a late signal. So that is why there is a small limitation in these indicators. In fact, not small, the limitation of the indicator is it gives you a late signal. So these are lagging indicators which will indicate the current trend in action. So maybe even if it is an uptrend, downtrend, it can give you a late signal. So that is the problem. Then comes the oscillators. Oscillators are where the direction market might go up, and before the market turns, the indicator will give you an idea. Look here, though the market is going up, based on the indicator, this can stop and reverse, this can turn. So you can see the idea from the oscillator is to stop and reverse, but the trend continuation indicator will confirm us, yes, the current trend direction is continuing. So however, the oscillators have the function of, it's a leading indicator. Before the trend reverse, it gives you an early signaling. So some people get excited, come on, if I can have these leading indicators, oscillators, my life is easy. Why should I waste my time with other indicators? Hang on, don't jump the gun. Sometimes these leading indicators can give you premature wrong signals, where if the market is further trending, for example, cases like Valuable One to Expo Lanka to all these stocks which had major rallies, sometimes these oscillator indicators can give you a wrong signaling. This can turn many times, but yet the market continued. So you see, there are problems with these indicators. So all these indicators are not perfect, but they definitely have their strengths. So what we are going to do is we will explore their strengths and then learn how to use their strengths and avoid their limitations with other indicators, and then have a kind of an integrated setup. So we will explore that in a minute. But for the moment, mainly these are the two categories of the indicators we have, okay? So if I can touch on a indicator which is very popular in the market, exponential moving averages. You can see, simply if you are following the naked chart, yes, which will give you a lot of information based on trend support lines, etc. You can see based on these levels. But in addition to that, these moving averages, the exponential moving averages, I have used a short-term and a long-term moving average, where you can see the purple line. It's the long-term moving average, the purple line. It's with a long period, and the dotted line is a short-term moving average. With the short-term and long-term moving averages, what we are trying to get here is to get a mass consensus idea between the long-term and the short-term traders. So based on that, these price analysis, the averages, we have an idea when the market is going down based on our moving average. When the short-term is below the long-term moving average, it confirms the market is currently trending down. When the market is trending down, you can clearly stay away from the market and not put yourself in trouble by taking buy trades. So then when the point when the market has a bullish cross, you can see our short-term moving average is crossing above the long-term moving average. This cross point is an opportunity for us to consider buy trades. Okay, so now our moving average, based on our moving average, you can now gear up yourself to make your buy trading decisions. Then again, after the market has reached its peak levels, you can see based on a bearish crossover, the market is heading downward. So as long as the previous situation where the short-term moving average is below the long-term moving average, the long-term moving average and the short-term moving average. So the short-term moving average has crossed below the long-term moving average. So this particular period, you can clearly stay away. So if you have your moving averages, it will help you to give you the idea. Look here, currently the market is trending down. So if you have this information, would you put yourself in trouble taking buy trades? No. So only when there's a crossover, and after the crossover, if market is trending upward, this is where you consider buy trades. But can you see the moving averages having a small problem? The trend is beginning at these levels, but our crossover signal we get somewhere at 32, but the trend started at 20 levels, but we are getting the confirmation at 32. Same way, the momentum has gone up to 76, but the end of the upward trend crossover is, we are getting the signal at 68 levels. So you can see there is a late signal. This is why it is called a lagging indicator. It gives you a late confirmation of the signal. So sometimes this indicator will have moving averages will have late signaling. So based on those late signals, sometimes we might have to take our decision making at 32 and exit at 68. But as professional traders, instead of making impulsive trades, we can, if you are only trading based on moving averages, you can comfortably trade at 32 and then exit at 68 instead of buying at, in an impulsive way at 20 and trying to reach 76, which if then you are trying to gamble the market without these indicators, which may be impossible to identify those points. But based on our rational indicators, this life our investment decision making is more processed and streamlined through rational steps. So this is the importance of using moving average. So now you can see by now with this introduction idea, how these moving averages kind of an indicator helps us to decide where to enter, where to exit, and whether the trend is continuing or not. So if you feel this Tokyo is momentum is slowing at this point, but based on your moving average, is there any crossover? No. Until there is a bearish crossover, until the moving averages are having in the same direction, the short-term moving average and the long-term moving average having the same direction, I think you can comfortably make your trade and continue your trade. So this is the benefit you will have using these moving averages. Okay. So I will show some examples of Colombo Stock Exchange Tokyo. Now again, Tokyo, the latest price charts, you can see how our short-term moving average is the blue line and the long-term moving average is the purple line. So I have used 11 and 22 as the justified numbers to identify a kind of a monthly average for the markets and a fortnight period to identify the short-term moving averages. So you can see when the blue line, the short-term moving average is below the long-term, it is clearly a bearish trend, and during this bearish trend, we will not take buy trades and we will stay away from the market. But the point it has a crossover at this particular level, now you can see we have a signal, okay, the market is becoming bullish based on our moving averages. So now after that, there are multiple trading opportunities, and these are called pullback points where we can learn in future. These pullback points will be opportunity for you to add more to your trade. And also you can you remember the resistance line we spoke about? So with this resistance and our moving average is pointing upward, we can expect some resistance breakout at these levels. So now you can see our historical resistance line price action analysis and our moving average indicator is giving us the idea to make our trading decisions. Okay. So this is the opportunity for us to make our trading decisions based on the moving averages. So I will go through another example. Haley's MGT again. You can see how our short-term moving average, the blue line is above the purple line, and you can see multiple trade opportunities, and you can see the volumes are increasing with that trend direction. That shows the trend is continuing in that way. Then I have used a trend support line where as long as the moving average is, our short-term is above the long-term moving average, it's a benefit for us. And then finally, at a particular point, you can see the momentum starts, where at this particular point, the volume bars are also increasing, and then a new trend direction in a steep way, the trend starts to go up. And also our moving averages are also in line with that direction, confirming we can continue the trade. So now you see the benefit of using moving average. Instead of simply following the price analysis without any idea, these indicators, price, volume, data, and our indicator overlays like the exponential moving average will give us some direction to make our investment decision without any impulsive way. So you rationalize your investment decision based on these indicators, and you comfortably in a professional way approach the market to identify and strengthen your profit. Sometimes this moving average, let's say you assuming you have entered your trade at these particular points based on the trend support. If you are closely following your trend support line and your moving average lines, then you can continue this trade without any worry, without any in-between volatilities. You can make sure the trade continues and hang on to that trade. But sometimes I know when the market is going to peak levels, these swings you can make buying and selling opportunities. where if you are making kind of an active trader in between, then it depends on your trading style. So different people will have different trading styles. So based on your trading styles, if you want to trade frequently within, buy at these extreme points and then sell at these extreme points, of course, you can use, there are more indicators to identify these extreme points in between a trend to buy and exit. So we will have to explore those indicators, which may be in a future session. So then I will touch, we have covered the trend continuation. Now I will cover the oscillator part. So the oscillators, they are leading indicators which will help you to identify turning points of the market there. So oscillators are mainly, the indicator will help you to identify emotional extreme points. You know, the market is mainly with this greed and fear sentiment. Okay, so when there is excessive greed during our bullish cycle of the market, people, whenever they spoke, they had this greed talk. I mean, mostly they were talking in a greedy way. I want to, keep this stock. I am so in love with this stock. I want more profits. So the more they become greedy, because of this greed thing, the market goes into a very overvalued state. And as a professional investor, we can take advantage of these emotional extreme points, this excessive greed and excessive fear. Even after the market had a bearish rally recently, people had traders who are not professional trading, they had excessive fear and they started selling the stocks at very cheap and very low prices. So at those extreme points, a professional trader will take the opportunity to collect those based on their excessive fear. So what we can do with these emotional extreme points, these indicators will help us to identify the fading points of these extreme greed and fear levels. Once you can understand this fading of those greed and fear points, you can, as a trader, these overbought. So these indicators will have overbought and oversold levels. Based on this overbought and oversold region, you can get ready to sell, and at oversold levels, you can get ready to buy. Okay, so this is how we can use these indicators to make our trading decisions. So we will quickly go through a indicator, oscillator, one of the famous indicators among the traders, stochastic, which identify these emotional extreme points where the indicator has an overbought level and oversold level. So the indicator oscillates between these overbought and oversold levels. So if you can identify these overbought levels of this price point, you can exit at that level in an advanced stage. And when you identify these oversold levels of the indicator, these price points, you can see after that it's reacting and it's going. So this oscillator stochastic has a K percentage and a K D line, which it goes into the description of the indicator, where we will not cover today. But for the moment, if you can understand how this indicator works, this will give you a basic idea. And I will show you an example on commercial bank, how this indicator works. You can see within a ranging period, when the market is in a kind of a range, and can you see this during a range period where the market is having a in between up and down trade, during this price phase, every time the stock hits its overbought levels, it goes down and then it reaches oversold levels, then reacts and then reaches the overbought levels, and then based on that overbought you sell. Then again it goes to the oversold levels, you identify the oversold based on your indicator and you buy again. Again it goes near to the upper level of the range, it goes, then based on that overbought signal you exit. Then again it goes to oversold levels, based on indicator you buy. So within this range pattern, the indicator is comfortably showing you nice signals of overbought and oversold. So any beginner trader who has who falls in love with this indicator might think, okay, this is really good, I can make my trading decisions. But the oscillator gives you a heartache, where once this support line breaks, this range level breaks, this range pattern is broken, and when the market goes into a new trend, you can see our oscillator indicator is giving you premature wrong signal saying oversold. So if you are trading based on oversold, what would you do? If it is oversold, you should buy. But if you start collecting every time the indicator is saying oversold, oversold, you are just collecting a downward market, and you are averaging the downward market, and then the market goes down, and finally after a long period it turns. Until then, the indicator is actually giving you a wrong signal. So by now you can understand this particular indicator, yes, does its fair share during nice range patterns, but when the market is trending, the indicator sometimes can give you wrong signals. So this is the reason we should, there comes the need to integrate these indicators, momentum indicators which we spoke about earlier, like exponential moving average, and reversal indicators like oscillators. So we combine these indicators and have a confluence setup which will help us to make our trading decisions in a very rational way. So if I can give you a simple example on multiple indicators, how we are using our multiple indicators to make our trading decisions. So you can see within this upward trend, if I'm using the price support also, commercial bank. So you can see after it has gone above from the trend support point, within this trend support, you can see the stock is near the oversold levels and starts to cross over. And again, when it comes to this EMA pullback, the exponential moving average range, and near its resistance, trend support level, with these trends of oversold levels, you can make a trading decision. And also at this particular point, with the indicator going upward, which is called the confirmation of the indicator in line with our price action. So with these and the volume analysis, you can see with multiple analyses, you are using price action, you are using exponential moving averages, you are using stochastic, all these indicators together, you can make a trading decision. Okay, so again, another example, John Keel's holding, how you can make based on your moving averages. Our short-term moving average is with the white line and the long-term moving average is the blue line. So currently our short-term moving average is heading downward, but during a downtrend, our stochastic is showing oversold. Does it make sense, right? So when the priority of the rules, if the moving averages are pointing downward, stochastic, there is no point considering that indicator. You can just ignore, because you don't want to trade against the trend. But once there's a trend support developed, and then there's our moving average starts to cross over above the trend support, and the short-term moving average is above the long-term moving average, you can see there are multiple market corrections within the uptrend based on our stochastic, which has buying opportunities, multiple buying opportunities during an uptrending market. And then finally, from 140, you hold on, and you maybe add more to your position at these levels once you identify these corrections in between the uptrend. And then finally, when our short-term moving averages crosses below the long-term moving average and starts a bearish trend, then what happens? Our stochastic indicator is showing oversold, but at that time you are no longer bothered with your stochastic indicator, because your primary trend indicator is currently showing the trend is down. So now, by now, you can understand how to use. It just gives you a glimpse, kind of a teaser to you, how to use these indicators in a logical way and improve your overall trading setup to make your trading decisions, instead of using one indicator or just isolate in without any integrated fashion. You just isolate in an isolated way. You use one indicator and make a decision, and with another indicator in another isolated way you make a decision, and you try to make a trading decision, doesn't work. But if you use all these indicators in a very logical sequence and an integrated manner, which is called confluence, where all the indicators are confirming you the direction, based on that you make your trading decision. So this is how we have to improve our technical analysis skills to improve our trading. Okay, so we are coming to the latter part of the session, which is trade plan and risk management. So hope you can remember, I spoke about avoid buy trades when trend is very bearish. Can you remember when our technical indicator, the moving averages, are giving you bearish signals? At that time, you should execute based on clear rules. as a professional trader, you should have a clear set of rules. Otherwise, what happens? You will make impulsive trading decisions. But when you are working with an institute, when you are working in a firm where they will have set of a kind of a mandate, a rule to follow, where based on those rules you have to execute. So you are more of a very disciplined trader. But when you are trading individually, there are no rules. So what happens? You try to make trades impulsive way, you just make random decisions and you try to execute rules. But if you can have a clear set of rules like this, avoid buy trades when trend is very bearish. How do you find out trend is very bearish? Based on your technical indicators. Trade cautiously when you are trading against the trend in action. So even if you want to take a trade, there are indicators to get those reversal opportunities based on divergence trading, where there are advanced topics of technical analysis. If you want to make those trading decisions, then of course, then trade based on your risk appetite. There, you should try to minimize your risk appetite and trade based on that. And definitely, if the market is very bullish, then of course you can welcome buy trades. How do you find out the market is bullish or not? Based on your indicators. And how do you find entry points? Based on your technical indicators. You can find pullback correction points, and then time the market and execute multiple trades within that uptrend and maximize your profit. So you see, these clear set of rules will guide you and help you to be a disciplined trader, and based on these rules you approach the market instead of trying to make trades in an impulsive way. So this is the importance of having a trade plan and the integrated risk management. And finally, I would like to touch the psychology and discipline. As a trader, you might have so many people telling you to buy, so many, or the broker might push you to, asking you to buy more, average the stock, or then finally someone might say it is overvalued, sell. So there are so much of market noise, so much of noise. As a trader, you have to be very disciplined and have that balance. Stick to your analysis, stick to your technical tools and indicators, focus based on that, approach the market based on that. This is very challenging, though it is easy to say. When it comes to the real market conditions, when people trying to bombard with you news, and so much of this, these days, the social media is so much influensive on us. All this information can lead us to make wrong trading decisions. But if you stick to your trading plan, which I mentioned earlier, and make your trading decisions based on that, this will help you to become a very professional trader. Okay. So simply, if I can put this idea, how to be a disciplined trader, stick to your trading strategy. You have to develop your trading strategy. You have to initially plan this and structure it, then maintain strict discipline to hold on to that strategy. Don't let your feelings cloud your perception of the market. Really, sometimes when you, with this trading strategy, you approach the market, you see it is so excited, going in a very bullish and bearish way. Don't let those market sentiments make your investment strategy to make you throw out of the window. But learn to control your emotions, the greed and fear. So instead of putting your emotions into action, put your plan into action, not your emotions. This is what we have to do. Okay. So during these market conditions, there will be a lot of emotions you have to go through. Sometimes people will have this excitement, the optimism, overconfidence, denial. Some people will have the fear, anger when the market is going down, then the panic, then finally when the market is so down, they despair, and then again when the market is going up, hope, then relief and optimism. Don't be a trader who go through these emotions and approach the market. Then what happens? Every time you sell at low and buy at high prices. So when you buy at high prices and sell at low prices, actually you always make losses, and that will help you to destroy your portfolio. So instead of that, making your decisions based on emotions, as a professional trader, you can see this particular chart. The same emotions can lead you to make wrong decisions, but instead of that, within this price information, if you can nicely give attention to our technical indicators, the moving averages, this gives you some bullish and bearish crossover points and the continuation of the trend and avoidance of the bearish trend. Instead of falling into the fear and panic and despair, if you can professionally guide yourself through this with the indicators, which will definitely help you to make informed investment decisions. So the suggested approach to finalize things, I would suggest everyone to learn the tools and method. Don't rush to make money in the markets. So the sole objective in this stage is to learn the key tools, continuously master them through backtesting. We are identifying this technical analysis. You can, with these charting platforms, you can historically test them and learn the tools. And do not focus on profit or losses. Try to paper trade. Since we don't have demo trading facilities, you can mark your trades on a paper and see whether those trading decisions were right or not. You can test yourself. Then that is stage one. Once you are comfortable with the tools and the techniques you are using, then you can go to the next stage, improve your win-loss ratio. So let's say you are trading, you are making 10 trades, then out of those 10 trades, if you are making 5 trades profitable or 6 trades profitable, so your win ratio is improving and your loss trades are only 4 or 5. So what you can do, if you can manage the risk of those 4 to 5 trades and maximize the profit opportunity of those profitable trades, you become a net profitable trader. I am not saying that there will be no loss making trades. Definitely, as a trader, you might and you will have loss making trades. But what you have to do is this: the mantra is very simple. Let your profitable trades run as much and cut your losses short. Let your profits run. This is the simple mantra. But it's how we are going to do this based on the foundation, the groundwork is based on our technical analysis, fundamental analysis, and our trading strategy and risk management guidelines. Based on that, we approach the market. So once you do the paper trading, you may backtest and then improve your based on the paper trading. You will understand whether your win-loss ratio is improving. So once those win-loss ratio is improved, of course, then you can go for the live market and you can test your emotions, because when no matter how much you learn these things and do paper trading, once you put your real money, then the game changer comes, where the emotional balance you have to make. Because sometimes even after having all this expert analysis and maybe you might have the fantastic trading strategy, but if you can't control your emotions when you approach the market and you get excited, you might fall into the trouble and you might get clouded and you make blind trading decisions and then you fall into the trouble. So to do that, I would suggest maybe with a smaller capital, you test yourself, test the waters, how these emotions are, influencing you to take wrong decisions outside your trading strategy or trade plan. So then you can journal yourself, and as a trader, monitor yourself and see whether am I having emotional imbalance when I'm making trading decisions. With a smaller capital, you can learn. Even if you make losses, you are risking a smaller capital. So this is the elbowed stage. So you can see, if you go through these 3 stages, this will immensely help you to make better trading decisions. So the course content for our the SEM is suggesting to have a 6-week program. We will be having these areas. We are covering chart analysis, technical indicators, confluence, trade plan, and risk management. The introductions we gave through our today's webinar, we will dive deep into those, and we will try to improve our overall analytical method. So I would like to end this session with a simple few quotes. Our famous market guru, Warren Buffett: the stock market is a device for transferring money from the impatient to the patient. So we definitely have winners and losers in the market. This is how the market works. But the difference, the game changer, is the winners are the patient traders who professionally approach the market. The losers are the impatient traders who doesn't have that knowledge, who doesn't have that idea how to analyze these markets and have that emotional balance and manage their risk and the money management skills. So if you can have those skills in your toolbox, of course, the market is a place for you to make money and enjoy yourself. So I would like to end this session with the quote: learn to earn. Everybody is in a rush to make money to earn, but I would say take some time to learn so that you can comfortably earn. Thank you very much.